I think everybody in the room knows me. I'm going to go over a couple housekeeping items before we get started. This is educational and illustrative purposes. If you have specific questions related to your situation, we will handle that on an individual basis. I want to get us going. Let's welcome Brenda, our CPA, to come and present the federal income tax update for 2021. Brenda?
Good morning. Most of you know who I am, but I'm Brenda Hunter, and I do a lot of your taxes. I have an office in downtown Oxford, but I work with Dan and Rocky and all of them here at DK&A. So the first thing, I know that a lot of you heard a lot about taxes in the last couple years. We haven't done one of these for a couple years, but there's been a lot of stuff in the news about taxes. Taxes are going up, taxes are going up. I still do believe taxes are going up, but our government has been fighting about this a lot lately. A couple bills out there. The first one was the infrastructure bill, and that one did pass, but it didn't really affect our tax brackets very much. So I always put this out here so people can see. People are always calling and ask about it. Where do I fall in this tax bracket? How far am I from the next tax bracket? If I do this, where do I fall? But essentially, the 21 tax brackets were not that much different from the 20 tax brackets. They just bumped them up a little bit. We are anticipating they are probably going up in 22, but our politicians can't seem to agree on anything right now, so it's basically a battle. The Build Back Better is still sitting in the Senate. The trillion-dollar infrastructure bill did pass, and they can't quite figure out how to pay for it. So those two things are battling right now, and they're still trying to figure it out. But in the meantime, these are the tax brackets for 21, and people just like to know where they fall. These are the standard deduction and personal exemptions for 21, slightly different from 20. They just didn't raise them for inflation again. There's still no personal exemption. There's just a standard deduction, and then you get an additional if you are blind or if you're over 65. I put this up here because we get a lot of calls about this. People don't really understand how trusts work. So just talk about it briefly. But most people have what we call a revocable trust. And a revocable trust stays in your Social Security number until you pass away. So at that point, you title everything in your trust. And when you pass away, it passes through to your beneficiaries. And usually it is taxed in the beneficiaries on their taxes. There are irrevocable trusts, and in an irrevocable trust, it's taxed under the trust. There's also some medical trusts. There's other kinds of trusts. But the question I get a lot is, why can't the trust pay the taxes? And it is possible in some situations. But one thing that people need to understand is that trusts pay a much higher tax rate than individuals. So I put this up here for that reason, because when people call and ask me this question, they need to understand that trusts, by the time they go over $13,000 in taxable income, they're already in a 37% tax bracket. So they go up very quickly to a high tax bracket. So let's just quickly go back to this one, and you can see that to be in a 37% tax bracket for individuals, in a single and in a married, it would have to be $628,000 to get in that same tax bracket. So usually it is more beneficial to pay the tax for the individuals than the trust. So while it may seem easier to have the trust pay the taxes, it's generally more beneficial to have the individual pay the taxes. And most trusts are written up that way. Not always. There are some reasons why the trust pays the taxes, but most trusts are set up that the individuals will pay the taxes. Now, what you can do is have the trust reimburse the individuals. And what we can do at our office is run a projection to tell you how it would be different if the trust paid the taxes and the individuals pay the taxes. And like I said, generally it's better to have the individuals. So you're paying a lot less tax if the individuals pay them. And then over here it also shows you that while individuals have way higher exemptions, going back here, your exemption trusts have very small exemptions from income. So this right here would be an estate, which would be a probate situation. Simple trust have 300, which would be a revocable trust most likely, and a complex trust would be an irrevocable trust. Only has a $100 exemption from the income before tax hits in. So just a simple, quick, explanation of why it is generally cheaper to pay the trust to the individuals in a revocable trust. There was a lot of talk this year about long-term capital gains. They did not change for 21. However, this is still in the Build Back Better, which is the bill that did not go through right now. It's still sitting in the Senate. So it could go through for 22, but it did not go through in the infrastructure bill. So capital gains stayed the same. The rates have gone up slightly as far as income limits, but they stayed 15% for singles all the way up to $445,000 and married up to 501. And then you don't hit the 20% until you get over those limits. Filing requirements, we always put this up here because there is always people who do not have to file. As far as income levels, we get those questions a lot for, say, a parent or a child who's working a W-2 job. They may not have to require if their income is below a certain amount, and these are the income levels over here. There may be other reasons to file. If a parent has a home and they get a property tax credit, they may still want to file to get the property tax credit, but they may not be required to for federal reasons. And then there also may be some other reasons they have to file, and it might be because they have medical insurance on the marketplace, or they have a first-time home buyer credit or something like that. There are some reasons you still have to file even if you don't have income that requires it. And what this means up here by earned income would be W-2, something that would require actually earning the income. Unearned income is investment income. So now we're going to start into the changes that have happened in the last couple years. So I'm sure many people are aware that 2021 was just a nightmare of a tax year for a lot of reasons. Part of what started it was the pandemic happened, and the IRS actually closed down for 2 months. So they were already behind when the year started. Then there were stimulus checks that went out, and they went out on based on 2018, 2019 income. In their rush to get these out, they kind of changed the requirements a couple times. They weren't quite sure what they were doing. They went out to deceased people. They changed how they were doing it. It was kind of chaotic. And it caused a lot of problems with everybody, tax preparers, individuals, and the IRS. So it kind of created chaos, and at some point, there was, I think, about 80 million returns that were backed up in the IRS. And part of the reason is that people didn't know what they were supposed to do, and a lot of people didn't even realize they got the payments because they were odd amounts. Some people thought they didn't get them, so they filed rebate recoveries when they actually did get them. And so that these people shouldn't already got them, thought they didn't get them, filed for rebate recoveries, and then those were sitting trying to be reviewed at the IRS, which was understaffed, behind. And then even people who there was nothing wrong with their return were getting backed up by all these returns that had problems. In the meantime, in 2020, I'm not sure how many of you are aware of this, but in March, they changed legislation and made unemployment not taxable in the middle of March. So anybody who filed their return, in the first couple months had to amend their return, or then they decided they were going to auto-amend their return. And same thing with the premium tax credit for health insurance. So all this craziness caused the IRS to just be in a state of chaos. So now we fast forward to 2021, the IRS is still not completely caught up. So tax preparers spent most of our summer calling the IRS on notices and problems from 2020. So in 2021, there was more stimulus. Now this one might be a little simpler because instead of the odd amounts of checks going out, because the one in 2020 was prorated based on your income. So they adjusted it for 5% if you were over a dollar amount. In 2021, you either got $1,400 or you didn't get $1,400 per person on your return. So that will make it a little simpler. They also did a hard cutoff at $75 for single, $112 for head of household, and $150,000 for married filing joint. So there was no 5% adjustment on it. So it did make it a little easier for people to figure out they either got it or didn't get it, and now they can still file a rebate recovery to recover that amount. So it hopefully will be a little easier for people to look in their bank account and say, yes, I got it, no, I didn't, but I'm sure there will still be some issues on this. So basically, if you got it, you are supposed to get a form in the mail. In 2020, it looked a lot like junk mail. So this became a problem because people threw it away. It looked like a letter from the White House. So we're hoping they do a little bit better this year and make it look like an actual tax document. But if you got it, we have to report that you got it. It's not taxable. If you didn't get it, we fill out a form and it's recoverable on your 2021 tax return. The other thing is, because what happens is if your income was higher in 2020 but goes down in 2021, you're still able to recover that amount. So that's why there's the recovery. Or also if you had a baby in 2021, you wouldn't have gotten it based on your 2020. The other nightmare in 2021 was the child tax credit. So the government decided that people can't live without upfront money, so they started deciding that they needed to send out pre-child tax credits. So it was actually money that you're supposed to get on your 2021 tax return, but they decided it was a good idea to send it to them early via automatic deposits into their bank accounts. But this created a whole host of problems because, like the stimulus, people don't realize they got it or how much they got. So you could go opt in or opt out of this, but in order to opt out of this, you had to both parents had to go into the system, create an account, scan their driver's license, scan their faces, and opt out. So it created a whole host of problems, and most parents didn't do it. And now many of those parents don't realize that money they were counting on to pay taxes on their account or on their tax return has already been received. So now this year, that's going to be on their tax return. And like the stimulus, now they have to get a form at the end of the year and figure out how much they got. So it's going to create a lot of problems with the IRS reconciling this money, as well as tax preparers trying to get these forms from clients. And the reason I tell you this is because it's going to back up everybody's tax returns come tax time. Even if you don't have this issue, again, it's going to back up all the returns in the IRS.
Are they sending us something to show like a 1099 or something?
Yes, it's supposed to be a 6915 is the form you're supposed to get,
Okay.
telling you how much you got. And hopefully it'll look, again, more like a tax stack and not a letter from the White House. The big problem with this one is parents who take kids every other year. That's going to be the problem, again, the problem with this one. But there's going to be a lot of problems with this one, but we'll see. Education credits, there weren't a lot of changes in this this year, but they did change the phase-outs, the phase-out amounts for all of these slightly. The one big thing they did, they got rid of the tuition and fees deduction, and instead they upped the phase-outs for the lifetime learning so that the phase-out amounts for income are the same for both American Opportunity and the lifetime learning credit. So these are the two education credits that still exist. The big difference between these the two education credits, the American Opportunity is more for people that are pursuing a degree, taking regular classes, and enrolled at least full half-time at an institution. Lifetime learning can be for anybody who's taking, you could even take one class. And you don't have to be going for a degree. Anybody can go take a college class in philosophy, anything, and take this. It's 20% of the tuition up to $2,000. Don't have no minimum age, no minimum requirement or degree, and you can take that on your tax return as long as you meet these phase-outs on income. So there's some other miscellaneous changes that happened on 2021 this year. Unlike 2020, unemployment will be fully taxable. Last year, many of you may remember that they decided to give you a $300 charity deduction This year, they're giving single people a $300 and married people a $600 charity deduction. This is above the line charity deduction. So you don't have to itemize, it's just, I mean, you have to have charity, but it's not just an automatic thing. So if you come to get your taxes done, please tell us that you have the charity. Don't just assume we're gonna give it to you. And then there was a lot of talk about student loans this year. They went back and forth about talking about student loan cancellation. They didn't end up doing a lot of this, but there were some private problems with some student loans that they used unfair practices. So if there was some student loan cancellation, it's not taxable. So normally, if like you have credit card debt and it's canceled, you get a form called a 1099-C, and it's taxable to you. If you do have a student loan that was canceled, if you're one of those companies that got canceled because they decided they used unfair practices, those would not be taxable, and that is through 2026, and that runs out. And then these are the HSA amounts for 2021. For the individuals and families, you can put in $3,600 for an individual, $7,100 for a family. If you're over 50, you can put in an extra $1,000. You'd have to have more than the standard to be able to itemize. And really the biggest factor is probably going to be your mortgage interest or your charity. I have people that have a ton of charity and still itemize. I have people that have a ton of mortgage interest and still itemize. Sorry. But the hard one is that SALT deduction, because it limits your real estate taxes and your state withholding. And they are actually that in the Build Back Better, just so you know, one of the things they might change is that SALT deduction, is they're trying to, that's one of the things that might change with that in 2022, is they might take away that limitation of $10,000. So that might come back, and that might let more people itemize, because that's what limits a lot of people, is that because your state tax, your withholding or state payments, and your license plates can not be more than $10,000, which keeps a lot of people from going over the 27.5. There's also a lot of tax increases in the Build Back Better. So you might save on your itemizing, but there's a ton. That's where there's so many things. They're talking about capital gains increases. They want to lose the ability for estates to increase stepped up basis on estates for properties and stocks and stuff. There's so many things they're fighting about in the Build Back Better. I don't imagine that's going to be an easy pass. And I also imagine what's going to happen, the same thing that happened with infrastructure. It gets passed in pieces, and they realize that they don't have the funds to really do what they thought they could, so they're going to then have to figure out how to pay for what they passed. So we'll see. So for retirement planning purposes, these are the numbers for if you're putting away money. So the 401k contribution limits have gone up, simple plan, IRA contributions have gone up, and the phase out limit. One of the things that was talked about a lot was getting rid of the Roth conversion amounts. That is still in the Build Back Better. Sorry, it's hard sometimes to keep them separate. But the Build Back Better, one of the big things that they were pushing was was getting rid of Roth conversions and backdoor Roth conversions. That's been talked about a lot in the Build Back Better. They're really trying to get rid of that ability. It has not passed. For now, you can still do Roth conversions, and you can still do put in Roths up to these amounts. So for retirement plan rules, as many of you knew that in 2020, you did not have to do an RMD. They were not required in 2020. In 2021, you were required to do an RMD. They brought that back. The other thing they did in 2020 was they raised the RMD amount. People were living longer, so they rose the age from 70 and a half, if you were not already taking RMDs, to 72. So that's the age it is now. They also changed all of the RMD tables. So if anybody is calculating their own RMDs and you need a copy of that table, let me know, because I can get it for you. I would say 90% of people use the uniform life table, all the calculating numbers changed on the uniform life table. Like I said, the backdoor Roth was retained right for now for 21 and 22. That was talked about in both of those, that they were going to disallow that. And anybody who doesn't know what a backdoor Roth is, if your income was too high to actually put in money in a Roth, what some people did was they did a non-deductible IRA and then did a Roth conversion and moved it into a Roth. That's what a lot of people who are still working did. They called it a backdoor Roth. So a lot of people don't take advantage of this, but a great opportunity, if you do put a lot of money in charity and you feel like you lost that ability due to this higher standard deduction, a lot of people are doing a qualified charity distribution out of their RMDs. And what that is basically through your IRA RMDs, you call your brokerage company and you have them put the money directly to your charity, your church, whatever 501c3 you want to have it sent to. It goes directly from them to your charity, and it comes off your income completely. So not only do you save on the federal, but you also save on the state as well. So for some people who missed that cutoff on the state of 1946, where they changed the state laws, anybody younger than 1946 got grandfathered into the old rules where you had the much higher state calculation of income exemptions on retirement income, but anybody younger than 1946 only gets $40,000 of retirement income, and that doesn't include your Social Security. Social Security is fully deductible, not taxable on the state. But other income, you only get $40,000. Now, older people than 1946, they get approximately $96,000, which is much higher, plus their Social Security. So the state came in and changed the rules, but they let anybody, at the time they changed it, get grandfathered into the old system. So one of the things people are doing is this qualified charity deduction, because that allows them to do their charity if they're already giving to their church or already giving to the Humane Society or already giving to something they feel strongly about. Just goes directly through their Fidelity or whoever, and then they still basically get credit for it without having to, itemize.
When is that normally done at the end of the tax year?
You can do it anytime. I wouldn't wait till too late, because December is a really busy time, as you know, with Roth conversions and stuff. You can do it anytime through the year. And then it just shows up on the 1099 as, I think, QDC or something like that, quality charity, QCD. So it comes right off your tax return. It's non-taxable. I know a lot of people some people are already doing that, quite a few people, but it's a great way to save on taxes and still do the charity you may already be doing. And it can go directly to your church. It'll tell them it's from you. It goes on a check right to your church. So another thing that happened in 2020 was elimination of stretch IRAs for beneficiaries. And this would be for non-spousal beneficiaries. So if you inherited an IRA, it wasn't from your spouse, you used to be able to do whatever you want with it. Now the IRS said you have to take it out within 10 years. And a lot of you may have already heard that from Dan or Rocky, but the IRS is trying to get people to take this money out sooner and pay the taxes, is basically. Roth IRAs are not, the RMDs are not required out of your Roth, but if you inherit a Roth from somebody else, you are required to take RMDs. The other question we get a lot is the penalties for missing an RMD. And that penalty is really high. It's 50% of the RMD you missed. However, I will tell you that I have never seen anybody get a notice on this. So while I'm not encouraging anybody to not take their RMDs, I will say it does happen sometimes, usually an accidental reason. You didn't take the right amount, or you were moving money around and you missed it accidentally. Generally, what we do tell people is to take it as soon as you realize the mistake happened, and we'll write a letter for you. I've really never seen anybody actually penalized for this. So that's what I would tell people is, don't do it on purpose, obviously, but if you do miss one, take it as soon as you realize the mistake. And if you do get a notice, let me know, and we'll write a letter and to the IRS. Tax rates have been crazy low. I know people don't feel like that, but they have been crazy low. And we anticipate that, you know, they're trying really hard to raise them. It's just because there's kind of an even pull right now in the government of, you know, two different, you know, parties trying to argue this fact, but some, you know, it depends on what your income becomes, but if you want to see what that'll cost you, I can do a projection for you and do different amounts to see, like what, anytime anybody is considering a Roth conversion, I can run numbers for you, and we're really good about planning for you to make sure it doesn't cost you too much or hurt you in other areas.
What's the maximum you can convert to a Roth?
There really isn't a maximum right now, but there are reasons to not do too much. I mean, there's social, and we'll get to that later, but there's a social, you know, you want to be careful because if you do too much, it's going to raise your Medicare. It depends on what your goal is. Some people want to convert a big amount, get it over with. Some people want to do a small amount each year. A lot of people have different goals, so it just depends. And that's why we do a lot of planning, because everybody has different goals and different reasons to do it. So in 2020, a lot of people, because they were not working or whatever, they actually declared a disaster for tax purposes and allowed people to take up to $100,000 out of their IRAs or 401ks due to COVID. And if you did that, you could pay it all in one swoop, or you could pay it over 3 years. So if anybody did that, they're going to get a form, an 89, and then they have an 8915, and they have to pay that to 2020 was your first payment, 21 would be your second payment, and 22 would be your third payment. So this will be the second payment on those if anybody took a qualified disaster retirement plan distribution. We get a lot of questions about Social Security and how this works. So if you choose to take your Social Security early at 62, and I don't know if they consider that early, but it's not full retirement age. So the way Social Security works is your full retirement age is between 65 and 67, depending on when you were born. If you were born between 1937 and 1960, it's prorated every 2 months to determine what your full retirement age is. If you retire at 62, which you can, or collect Social Security at 62, which you can very much do, they don't consider that full retirement age. So if you choose to work and earn money, you cannot make over a dollar amount. And you'll see from here that I think I flipped those. I think 21 is supposed to be 19,560 and 22 is supposed to be 19,960, sorry. But they reduce your benefits by $1 for every $2 you go over that amount. And a lot of people get really confused by this, but you can have investment income, but you can't have earned income, and that would be from a job or anything such as that. Once you're 65 or 67, depending on your full retirement age, and you can go on the Social Security website and look that up, or I can send the full table to you. Once you get your full retirement age, you can make as much money as you want. In the calendar year where you reach your full retirement age, in 21 it's $50,520, 22 it's $51,960. In that exact year, you can't make over that amount, or again, they will take back from you $1 for every $2 you go over that amount. Again, once you get your full retirement age, you can make as much money as you want and not mess with your Social Security. This is what I was talking about, Jimmy, about your Medicare rate. So this is one of the reasons some people plan specifically is trying to keep their Roth conversions and their total taxable income under a certain rate. So if you were trying to, so in 21 and 22, so everybody's Medicare went up in 22 to 170.10 minimally. So you know, if your income goes above a certain amount, it might go up slightly more. So that's just, you know, you would have to consider maybe that cost is worth it because taxes are going up. Maybe it's worth it because what would happen is your Medicare rate goes up for 2 years and then it comes back to whatever the rate is here. So, you know, what is that, $60 a month? So that's the cost you have to look at. My taxes are, you know, you're going to get Roth money, which is tax-free, growing for the rest of your life. So maybe it is worth it, that's kind of one of the projections that we would do for you. Maybe it is worth it to roll that money over, get it in a Roth, and have it grow tax-free, versus your Medicare going up. So that's kind of what we would do for you, figure out what the amounts are.
Okay, if you don't have Medicare Part B or C, that's not even a factor then for the law.
Yep, not even a factor for you. Yep. The requirement to prove that you have health insurance, that went away a couple years ago, but there are still people on the marketplace. So if you do have health insurance in the marketplace, you are still required to get a 1095A and to file an 8962 premium tax credit form. In 2020, another thing that changed mid-year was the way this form works is you file the form, you reconcile the subsidies you got from the government for your health insurance. You either owe back money or they owe you money, depending on how closely you guessed your income. Well, halfway through the year last year, they decided and you didn't have to pay back that money. Your unemployment wasn't taxable and you didn't have to pay back any money you owed on your health insurance. Also created a lot of chaos last year. So in 2021, that doesn't happen. You do have to, well, as far as we know, again, they could change it, but this year you do have to pay that back, and you do still have to get that form and file the 8962 reconciling your marketplace insurance. But nobody still has to prove that they have health insurance. Estate and gift taxing. So you can gift. In 2021, it was $15,000. It's been $15,000 for about 5 years. In 22, it did go up to $16,000. So you can gift $16,000 to anybody that you want. Per person, if you're married, you and your spouse can each gift $16,000, and it's not taxable to them, and it's not a deduction for you. And you do not have to file anything. If you want to record it, that's up to you, but you don't have to do anything about it. If you gift more than $16,000, or as a couple, more than the $32,000, then you have to file a gift tax return. It's a 709. Last year it would have been $15,000. It would have been $30,000 to one of your children or somebody else. Then you have to file a gift tax return, but it's still not, there's no tax due on that return. It's simply a form that you notify the IRS that you gifted this money, and what it does is it comes off these lifetime exemption thresholds. So in 2021, the threshold was 11.7, and in 22 it's 12,060,000. So what happens is it just comes off this lifetime exemption amount. If anybody has a small business, for C Corps, one of the big things that they talked a lot about was raising C Corp tax rates. S Corps actually flow through to your personal, so that would go with the personal rates. But C Corps pay their own tax rate, and they talked a lot about increasing those rates. They are still talking about that in the Build Back Better, just like raising personal rates. But they did retain the 21% tax rate. Mileage rates, 56 cents a mile in 21 and 58.5 cents for 22. Business meals went from 50%, it's been that for forever, it's now 100%. So in 2020, 2021 and 2022, businesses can write off 100% of their meals, business meals. And part of this was to help small businesses, and part of it was to help restaurants that really struggled with the pandemic. Both C Corps and S Corps get a QBI, and what this is it's a qualified business deduction. So the first 20% of their net profit, or first percent of their net profit, is not taxed. And this was meant to help businesses, mostly small businesses, because businesses that are large don't actually get to, once you're over a certain dollar amount, you don't get to benefit from this, but the first 20% they don't pay tax on. So that was a big thing that started back in 17 in the Tax Cut and Job Act. That was going to go away, but it was retained, it was saved. The 179 bonus depreciation, that stayed at 100%, and they've raised the amount a little bit up to $1,050,000. PPP loans, very big thing going on in the last 2 years. Started with 2020 when the pandemic started. trying to help small businesses, trying to help keep people off unemployment. Not sure it did a good job, but that was the goal, was to keep businesses paying people while they were not working or while they were closed. And for a long time, it was supposed to be taxable, or, it ended up at the very end of December, they decided it would not be taxable as long as it was used appropriately. Then they did another round of those, were real big in 20 and 21. They also did EIDL loans. They are not forgiven, but they do have to be paid back. They did delay the payments, sometimes up to 2 years, and reduce the interest rate. There's also ERC credits. Those were meant to pay people when they were off. And if businesses paid their staff while they were off caring for themselves, caring for sick ones, caring for employees that daycare was closed or whatever, that is fully taxable to companies if they got those ERC loans. Those were supposed to go all the way through 21, but the infrastructure bill stopped them in the third quarter. That is partly because of the infrastructure bill and is supposed to help pay for the infrastructure bill. So they've been trying for about 5 years or so to get cryptocurrency to be recorded and on people's tax returns. So cryptocurrency has kind of gained a lot of steam in the last 5 years. A lot of people dabble in it. Some people are really heavy into it. It's basically a virtual currency that people trade in, similar to a stock or a mutual fund. And some years are better than others, but I'm sure you've heard the last couple of years it's been very, very strong. But a lot of people like it because it's not reported mostly. Some companies do report it. Robinhood Securities reports it. Some Fidelity does report it. They're really pushing Coinbase and some of the other ones to get on board. So in January of 2023, part of the infrastructure bill is the government has made it mandatory that they report all sales and all cryptocurrency, which is Bitcoin. We don't know if that's actually fully going to happen, but that's what the bill says, and that's what they're trying to do. So they've been trying to get people to come, even without a 1099, investors are always supposed to report any activities of buys and sales of anything. So we'll see if these 1099s come out, but starting in January 23, which would mean calendar year 2022, they're supposed to be reporting all activity. Sales are treated similar to stocks, with gains and losses reported and gains paying capital gains. The government is expected $28 billion over 10 years, and this is supposed to help pay for the infrastructure bill. So the other thing the government is going after is foreign bank accounts. And these aren't taxed for the most part, but for some reason they're really on a mission to find out who has them and where they are. Some of this started a little bit after 9/11. They started really pushing to find out foreign bank accounts. If you have more than $10,000 in a cumulative value during any year, you are supposed to file a FINBAR. We do have a lot of clients that do file these, but we are supposed to technically ask every single client every year, do you have virtual currency and do you have a foreign bank account? If you do have money, you are supposed to report it. There's no tax on it. It's just a reporting requirement. There are penalties if they find out you do have this money. And, many of you may have heard the government was trying to pass something that if you deposited more than $600 in your bank account, that was a big thing in going round and round. That did not pass. I'm not sure the government has time to watch deposits over $600 right now, but they were trying, and that was the reason, I think, was part of it was the cryptocurrency and part of it was the foreign bank accounts. But it's kind of funny, I have two clients, one that got his bank shut down because he deposited on a couple of occasions more than $10,000. And I had another one that got a letter in the mail that said he was consistently depositing $9,900 in cash, and he got a letter that said, we know what you're doing. So it was kind of funny, and neither of these two are doing anything illegal. They just have a lot of cash in their business, and so they are watching. In case you didn't know, if you deposit more than $10,000, it is the government is reported. So this year, tax returns, the last 2 years, they've been extended, and it's been a nightmare for us. We've had no life for the last 2 years. 2 years ago, it was July 15th. Last year, it was May 15th. We're finally back to a normal tax season, although it's still not April 15th. It is April 18th because April 15th falls on Emancipation Day, which is a Friday. So tax returns, both federal and state, are due on April 18th. We do have many requests that people don't actually want a paper copy of their tax return. Certainly, we normally do print them out, but if you don't want them and don't want to waste paper, we can give you a PDF copy. Just let us know when you come for your appointment or email or drop off. We have to have a signed copy of your 8879 to e-file your tax return. Two things we have to have is a signed copy of an engagement letter. That's what gives us permission to do your tax return, and a signed copy of the 8879, and that's the one to file your tax return when it's done. Because we are a CPA firm, we have to have those two documents in our office. And we do, for many clients, we will do it on a verbal, as long as you get the 8879 back to us pretty quickly. We do have the ability to email all these things now. Pretty good now with emailing, and part of that is with these links that we have. So our software allows us to do a secured folder that allows us to send you a link in a secure format that we can send a folder to you that you can upload documents into it, and it's completely secure, so your Social Security and any other documents will not be compromised. We can also send you a copy of your return that way if you want a PDF copy of your tax return. We can also send you the 8879 or any other forms you want. So if you're not close, or if you travel, or go to Florida or whatever, or some other sunny state that's warmer than Michigan. If you want to receive a link or a copy of your return, that info, this email is our general email, or you can email me and we can get that to you. Make your appointment early. We are already filling up very quickly. If you want an appointment, you don't necessarily have to have an appointment. If we've done your return for several years, a lot of people do just drop off or email their documents to that address through a secure folder. Make sure you have, some people don't have their brokerage forms because I know they come in late. Kim can get me those as soon as they come in here. Again, she sends it. We have a secure folder that we pass documents back and forth. So if you have everything else, you can get those to me and just let me know that's the only thing you're missing. And then just if you have a lot of receipts for charity, medical, or business expenses, if you total those, it does speed things up for you. This is our website. On our website, we do have a lot of blogs on some of the stuff that I've talked about. Some of the bills that have passed, or things like the child tax credit, or some of the things that have happened in the past. So if anything changes, and it may affect you, there are blogs on our website that sometimes explain some of those. So we're waiting to see what's going to happen with the latest tax bills. Always anxious to see how, and all our forms are on there too. So if you go to our website, the engagement letter's there. There's also, Dan sends out lists of like the 2021 list of what you need and that stuff. But if for some reason you lose it, can't find it, that's on there too. So all of our most used forms are on our website. All right, well, thank you, everybody. I'll give it back to Rocky.
All that advanced planning, tax mitigation strategies we do, and we help you with those. Everybody sitting here's situation is different, so you really have to look at it on an individual basis, and that's what planning is, right? So we appreciate working with you guys. We look forward to working with you. I want to give you a quick minute on upcoming events. In February, we are doing a webinar. Okay, it's a lot of data. We're going to do it as a webinar. We're going to spread these out, but it's going to be an online webinar, Thursday, February 17th. It will be recorded, so it'll be available on our YouTube channel, just like this will be once it's edited and approved and sent out. So you will be able to either join us live online or watch a replay of it. Okay, so that's February 17th. So just a reminder, there's no need for you to worry. You take care of your family, and we will take care of you guys for 2022 and beyond. So thanks again for coming, and good to see everybody again.